as HUL is concerned, the important part in these third quarter earnings is that they've hiked that royalty payment to the parent Unilever, and that's going to be effective from the 1st of February. The management spoke about the rationale why they've gone ahead and hiked the royalty to the parent. Listen into what they said.
When it comes to royalty, you must always look at it from a lens that, yes, this is an expense for benefits received.
To us, royalty, central services is a very important, necessary investment. Royalty is one of the element of cost like any other cost in the business, royalty and central services. So the way we see there are multiple costs in the system, there are multiple efforts of driving savings in the business. And of course, we have a big job in terms of driving portfolio. So rural, the way we see, if I look at current last 3 months for rural, the market has grown. FMCG market has grown by 5%. These are the numbers we were talking being flat and with a double-digit volume decline. What we now have, volume decline has been reduced. Now it's 7% volume decline for rural market, but value growth is 5%.
All right, so the management talking about the hiked royalty to Unilever. But let's get perspective on the entire FMCG pack. Let's digest these numbers and also get a sense of where the FMCG pack is going from here. Shirish Pardeshi is joining us to help us do that. Senior Analyst for FMCG at Centrum Broking, and Abneesh is also with us, the Executive Director for Institutional Equities at Nuvama Group. Shirish, coming to you first. Now, these inflation wars that we've had, they've hit FMCG companies in the recent past. But now as we see these raw material prices dip, do you see a secular rising of fortunes for FMCG companies, or is that still at some distance? It's still some time away.
Thank you, Vikram, having me on the show. Two things before I get into the explanation on your question. I think over COVID period, I think what we have seen, the income generation activities has been little slower. And there are various quarters of people, government, everybody's trying to do intervention. However, we have to also keep in mind the food inflation and fuel inflation is also hitting the mass consumption. Now, on these two things, one has to keep in mind that the recovery is slightly delayed, and to top it up, we also had the delayed monsoon, monsoon was prolonged, and now we have a delayed winter also. To answer your question, the inflation which is here, and when we watch on a weekly, quarterly, monthly basis, I think yes, inflation is cooling off. But the larger impact of this inflation can be seen maybe another 2 or maybe 2.5 months away. So there is a lag which is there at this point of time. However, the good news is that the inflation data also suggests that it is cooling off, and the food inflation is, I'm not saying it is within control, but it's directly looking down. So that gives the positive sentiment to the consumer and also the spends which can go up. Now, that too context, when we see that the inflation, per se, companies are also conscious and they are also trying to get the benefit, and they also know that the demand is under stress. So given these two fundamental reasons, my personal view is that the benefit of inflation, once starts coming up to companies, they will try and pass it on to the consumers. And that is also one way to look at the demand will lift further.
Absolutely. And the expectation is, when you talk about the Indian growth story, and we are not too far away from the presentation of the union budget, Abneesh, one talks so much about the resilience of Indian domestic demand. A lot of it is going to be seen in how FMCG does. So when you look at the kind of numbers posted by at least these two FMCG companies, HUL and Asian Paints, do you see any common threads emerging as far as the current state of the sector and the outlook for its growth, and whether or not we're going to see FMCG really drive demand?
Yes, thanks. Definitely, I would expect the outlook for all the large listed FMCG companies to improve further. Definitely, if you see Asian Paints commentary also, in December, they have seen double-digit sales growth. Yes, in January, there could be some impact of the harsh winter in North India, but that demand will come back. Plus, marriage demand also is quite strong. Definitely, because of the peak raw material inflation behind, FMCG companies have multiple levers to use that. The promotions and the LUPs, which saw huge impact in the last 2 years because of the grammage cuts, etc. There, my sense is grammages and promotions will come back, which will again drive the volume growth. Apart from this, FMCG companies are extremely agile and they will also enjoy higher profit growth, higher EBITDA margins also. They will not at all pass on the full benefit to the customer because last 2 years they have gone through this pain also. So they operate in a band of margins, and whenever the raw materials correct, they do enjoy 3-4 quarters of heightened gross margins and EBITDA margins. Third point is definitely the D2C bloodbath, which is happening in our view. That's clearly very positive for FMCG because FMCG companies will get opportunity to do M&A, plus the competitive intensity from the startups of D2C will definitely reduce significantly because of the funding dry up. So that's also positive. So overall, yes, outlook is definitely improving. We'll continue to prefer the leaders in the pack. Yes, for HUL, the royalty issue is a near-term negative. But in the broader scheme of things, I think it's not too much of an issue. It's a near-term issue. But I think over a period of medium term, this will clearly be absorbed and it will be back to fundamentals of the business.
That's right. We've seen several FMCG companies, and that includes ITC, also go the D2C route, and we've seen their interest in Yoga Bar and the kind of acquisition that's happening. Oziva as well, as far as HUL is concerned, and perhaps that track is going to continue. But Shirish, when you look at the overall FMCG pack and you consider discretionary spends, how they are panning out versus the staples, where there could be larger growth, what's the split that you see, especially when you consider rural and urban growth for the FMCG pack?
I think the quarter which has gone by, the urban consumption for discretionary is still resilient. The more pertinent question here is that whether the urban growth will continue for a longer time. And to my best understanding, most of the discretionary consumption companies are leaning more on the metros and tier 1. The larger consumption, I mean, take an example of Asian Paint also for that matter, the larger consumption comes from the urban markets. Now, if the income velocity is intact and the larger mass consumption is going to come back, I think I don't see there is a challenge. Yes, the growth rate between the discretionary and non-discretionary was higher. I think the gap is now bridging. But I would continue to believe that India's captive consumption, and given all these macroeconomic effect, which will be visible another 15-20 days, what the government is taking a position. But I think I strongly, firmly believe the inherent latent demand, which is there, is here to stay.
So if the latent demand is here to stay, then the outlook is going to get more and more positive. But if you look at the last 3 months, Abneesh, the FMCG index has underperformed the benchmark Nifty. And that has been the story. Now, if you look at the next 3 to 6 months, what's the kind of outlook? And if the outlook is as positive as both of you are hinting towards, then which are the kind of businesses within the FMCG pack that you see drawing that much further growth, that much more traction when it comes to demand as well?
Sure, thanks. So definitely over the next 3, 6 months and 9 months, I would expect the staples pack to do better. Overall, there is a global recession, so there is a risk of, and FMCG companies provide much better visibility in terms of earnings growth also. Second, of course, is we will also see discretionary underperform. So I am not referring to discretionary within FMCG. I am referring to the broader discretionary consumption, say in the retail, etc. Because of the job losses in the startups and the job addition in the software and the IT pack also being at a multi-quarter low, I think there is some headwind and some risk which is going to emerge over the next 2 quarters for urban consumption in such discretionary categories. But for FMCG, I think next 2 quarters, urban will still grow faster than rural, and post that, rural should start coming back to much better growth numbers. So yes, I will say that FMCG definitely looking good. Within FMCG, I think in the near term, foods will clearly outperform. So noodles, biscuits, etc., will gain because of the inflation for the lowest end of the customer. So we will see biscuits and noodles grow faster. And the personal care and beauty, which has been languishing because of either delayed winter or say because of the slowdown in the lowest end of consumption, I think that should also recover as these factors get addressed. So overall, yes, we will expect Britannia, Nestle, HUL, these kind of companies, even GCPL to do better. But definitely, FMCG is a good space to be over the next 6 to 9 months.
Good place to be over the next 6 to 9 months. Shirish, do you agree with that? And what are your favorites among the FMCG pack, and which are the ones that you would definitely not want to have in your portfolio that you'd want investors to stay away from? Are there those as well?
I would refrain from myself segregating the companies in any bucket. But what the data trend, and if I look at the agriculture trend, I think the high frequency data suggests that income generation activity is taking its pace. So the mass beauty consumption which has been lower in post-COVID period. I think it is yet to pick up, and I think that's where my thought is. Having seen the trend in the consumption with the on-the-go consumption is improved, and with the improved mobility, I think I would bet that the packaged food segments will grow ahead of all the segments. Now, to give you another angle, and when we look at the mass staple consumption in that, when we look at the likes of toothpaste category or hair oil categories is not picked up. And I would say the recovery in these two segments is little far away, maybe another a quarter or two away. But clearly the trend suggests that if the IT is, it's a large segment of audience which generates a handsome income, and they're still working from home. And if that mobility comes back, working onshore, I think that is another quarter of consumption which is missing at this point of time, and that will drive the discretionary consumption as well. So my view is that I would put my preference for packaged food, followed to that mass beauty segment, and followed to that the discretionary.
Fair enough. Also very important to keep in mind is how these FMCG companies are going to protect their margins and the kind of pricing strategy that they're going to employ in times to come as input cost pressures ease up. But that's for a later conversation. Shirish and Abneesh, thanks very much for joining us with your perspective on this edition of India Tonight to talk about the FMCG sector and what's in store in 2023.